Today's meeting includes Paul Merriman talking about the ultimate buy and hold strategy, and our second speaker, Chris Pedersen, will talk about 2 funds for life, pre and post-retirement.
And then the second person I'd like to introduce is Chris Pedersen. Chris is, I would say, Paul's protege, and Chris has a background in engineering. So engineer, and then, now full-time working with Paul on the investment side of it. So he's been a lifelong buy and hold investor, but then I know you have your own twist on it, applying some of your technical engineering skills to that investment strategy. So we're really looking forward to hearing both of you guys present, and thank you for joining us.
Welcome to the second half of our day here at Silicon Valley AAII. It's a pleasure to be here. We just heard from Paul. Paul talked about the ultimate buy and hold portfolio and various withdrawal strategies. It was good material. If you have that as a foundation, I think it'll make this presentation a little bit easier to understand, because I'm not going to spend as much time talking about the individual asset classes and how they've performed in the past. Paul recommends and developed in that presentation a 10-fund solution called the Ultimate Buy and Hold portfolio. He also presented a 4-fund solution. And as I began working with Paul a couple of years ago, one of the questions that came up was, could we do something simpler? Could we use the same underlying principles and come up with something that would still produce a prudent, widely diversified strategy and give good returns per unit of risk, but not involve 10 funds? And so that led to this work we call 2 Funds for Life. And it'll be what I talk about here. It'll be something I enjoy presenting and introducing you to. When we first came out with 2 Funds for Life, though, one of the questions was, it sounds like you're talking about something that works well for young investors. What about people who are at retirement or in retirement? So in this presentation, I'm going to talk about it from all 3 perspectives. What it looks like when you're in your early accrual years, what it looks like around retirement, and what it looks like well into retirement. So that hopefully gives you at least a starting point of understanding what we're going to talk about. So when Paul and I first started looking at a way to produce a broadly diversified investment strategy for young investors that involved a smaller number of funds, we naturally looked at target date funds. And the reason was that they're ubiquitous. You may not invest in a target date fund, but I can pretty much guarantee you know somebody who does. Target date funds, as of a couple of years ago, about 77% of investors in retirement accounts held some portion of their portfolio in the target date fund. And about greater than 50% of Vanguard participants, so this is people holding Vanguard funds, had 100% of their retirement savings in a target date fund, which is staggering. And Vanguard itself owned at that time about 37% of the target date fund market, which is also staggering. So target date funds are, the way I think of it is they're kind of like robo-advisors on the cheap. Basically, it's a portfolio that does age adjusting of your risk, of the portfolio risk based on a date when you expect to retire. And it does it all for maybe 15 basis points. It's a very low cost if you get it from Vanguard. And since so many people hold those, and since they are broadly diversified, we thought, well, what if you started with that? Is there a way to improve on it? So let's look just a little bit under the hood at how they work. They start with this observation that we all have a lot of human capital early in our life and not so much late in our life. So at the age of 25, we have the ability to work for a good 40 years, most of us. Now, not everybody does, but the vast majority of people have a lot of working years ahead of them and an ability to trade their talents, their time, and their energy for money. So that's their human capital. As we get older, that human capital declines. And so our ability to come back from a financial disaster declines as well. You know, at the age of 25, if somebody loses their entire wealth, their whole worth, net worth, odds are it wasn't very much to start with, and they're going to have a lot of years to come back from that. They'll do okay. But if at the age of 65, somebody runs into a financial disaster and has their net worth wiped out, the chance of them being able to work another 40 years or, you know, achieve the lifestyle that they want with the human capital they have left is much, much smaller. So that suggests we can take more risk when we're young and we can take less risk when we're old. And the way a target date fund aims to do that, see if I got a pointer here. No, I lost my pointer. Let me grab it back. The way a target date fund aims to do that is by transitioning from riskier equity asset classes into safer bond asset classes. So it starts out with maybe 90% in equities, and then over time that transitions to something closer to 50% or 40% in equities, with the remainder being in bonds. And this is the industry average. You see that the equities are made up of U.S. large cap, mid caps, and small, non-U.S. developed countries, emerging markets, other. And then when you transition into the bonds in the early years, it's mostly government bonds, intermediate term, some high yield, foreign and cash, but then over time they also bring in tips. So the whole gist of it is let's lower risk as you get older, which all seems to make sense, right? So we wondered, though, how well do they work? And so, this is one of those questions that's really easy to ask but hard to answer. And the reason it's hard to answer is that it's not like a traditional back test where you just back test a portfolio of a fixed allocation. The allocation is changing over time. So if I built a table like Paul's, where we started in 1970 and ran one target date fund glide path through to 2020, you wouldn't really learn that much. You'd learn what that glide path did in one period of time, but what you really would like to do is say, well, what happens if I rerun that glide path starting in 1971 or 72 or 73? And so that's what we did, was we created a back test where we did these rolling simulations and came up with hundreds of simulations by sliding them each 1 month and then looping around at the end. So if you get to 2020 and you haven't run your 40-year simulation, you go back to 1970 and start over. It's called circular bootstrapping. So we did that, and we found that it looks like the curve is doing what it's supposed to do. But there's a problem with this chart, and it's underlined. This is a chart for a lump sum investment. Now, I don't know about you, but I did not start my retirement savings with a lump sum investment. I started out with very little, like most people do, and then I contributed over time. So if you look at the chart, though, for a lump sum investment, let's just look at that for a second. What it shows is the drawdowns you might experience in a quarter, a year, or in 10 years, or over the entire 40-year period of time. And at age 25, it's low and it goes up. And the reason it takes a little while to go up is it takes time for deep drawdowns to materialize. They don't just happen overnight. They might take 6 months or a year or 2 years to materialize, right? And pretty quickly it gets to 50%. It stays at a 50% worst case drawdown up until the age of 40 when you start ramping up the bonds. And then it declines until you get to the age of 60. So like I said, it looks like it's doing what it's supposed to do, except for this idea that you start with a lump sum investment. So we said, well, what would happen if we reran the simulation and we did it with regular contributions starting at 0? Now you see a totally different picture. Now you have your lowest risk across the entire chart is at the age of 25. This is when you have the greatest risk potential in your life, and you have less risk of a drawdown, a deep drawdown, than you would have at age 65 when you're on the verge of retirement and you really want things to be stable. So this is suggesting there's something wrong, that you could take more risk in these early years. And so that begged the question, could we do better? And how might you do that? Just to give you a better handle of why this chart looks so different from the previous chart, let's look at a back test of a fixed portfolio. This is all small cap value. Just I chose an asset class that has deeper drawdowns. And it's shown in two different ways. The one with the deep drawdown is somebody who has a lump sum investment, and the one with the shallow drawdown in the early years is somebody who's making monthly contributions. And the reason for the difference is, it's intuitive once I say it, it's that your contributions on a monthly basis are large relative to your balance, right? So if you're a year in, well, let's say 10 months in, just to keep the math simple, you're 10 months into your savings plan and your balance is, I'll just say $10,000 to keep it simple, and the market declines by 10%. Well, now you have $9,000 in your account, but at the beginning of the next month, you put another $1,000 in and you can hardly even see it. You can't tell that the market's down at all. And Paul has told me in the past that when he had worked with young clients through a bear market who were making relative contributions, a lot of them would say, oh yeah, the market's not that bad. I'm doing okay. It's, you know, it's hanging in there. I'm doing all right. And the reason is that you have this dollar cost averaging working in your favor. So you have a form of diversification that's really cool. It's called time diversification. So that's mitigating the volatility you see. And you're getting this chance to buy assets on the cheap, right? So when the market's down, you're getting a deal. You're bargaining, you're buying the on sale assets, which is really cool. And if you look at the right-hand side of this graph, you can tell once you're 20, 30 years in, that's not helping you very much. But in the early years, it's helping quite a bit. So if you've got this tolerance for more risk in the early years and you're going to invest in a target date fund like most people do, what could you do to improve? That was the big question we asked. Before I go there, though, the reason for this, like why is there less volatility in these early years, or why is there maybe less risk than you can handle? Remember this chart? There's bonds in those early years, right? There's bonds in the early years of a target date fund. So why put bonds in a target date fund for a young person? This is the way I think of it. It's like putting boots on at a track race. You're giving somebody protection that they don't really need. You're giving them the ability to lower some volatility and reduce the drawdowns they're going to see when they're really not going to see very big drawdowns anyway. So when we looked to ways to improve, essentially it started with this idea that the target date fund's problem is that it's tilted a little bit too far towards fixed income in the early years. So how might you tilt it back towards something that is going to give you some prudent risk and some higher potential return? And the asset class, if you remember from Paul's earlier presentation, that has admittedly some higher volatility, but also a chance at higher returns, the one that did the best was small cap value. So we said, well, what if you take a portion of what you're going to save towards your retirement, and instead of putting everything in the target date fund, just put 10% into small cap value, or 20% into small cap value, or 30%. And what would that do? Well, we were able to run those back tests with, again, the combination of the target date fund, changing asset allocation over time, and this new fixed allocation. And the target date fund, you can see over here, the worst case scenario was $3.5 million roughly. The median was $7.93 million, and the maximum was $12.8 million. You can also see the inflation adjusted end balances here. And these all assume that you're going to invest $10,000 per year for 40 years, increasing with inflation. So does it help? If you put an additional 10% into small cap value, the median goes up. We would have expected it to go up. It goes up by over $2 million. The maximum goes up. What's really surprising is the worst case goes up as well. So by putting just 10% into this different asset class, you've done a lot to offset that over-conservatism of the bonds in the early years. If you do 20%, it does more of the same, and if you do 30%, it does more of the same, right? It pushes it up higher. But how much risk, how much added risk are you taking on when you do this? Well, we looked at the worst case drawdown. So for a target date fund, it was 46%. It goes to 48, 49, 51. So the worst case drawdown doesn't get that much worse. It's a little bit worse, but considering how much more that you historically would have gotten, it looks like it's well worth it. There is a problem though. If you look at the worst case drawdown at age 65, you go from 26% to 37 to 45 to 50%. That's a pretty big change, right? And you can see it in the graphs down here at the bottom. Basically what's happening, especially in this 70% target date fund, 30% small cap value column, is the small cap value is growing over time to become more than 30% of your portfolio, and it has a higher risk of drawdown. And so as you're on the verge of retirement, your uncertainty in the amount you have saved for retirement is now 50%, which is just, it's really high. So admittedly, you're falling from a greater height, so maybe that's okay, but most people would probably prefer to have less uncertainty as they're nearing retirement. So we were trying to figure out, how do you get the benefits of adding this equity class to offset the over-conservatism of the target date fund in the early years, but also not end up with too much risk nearing retirement? And so what we came up with, and this is really at the core of Two Funds for Life, is this idea that we scale the higher risk reward asset class with age, so that by the time you get to your retirement age, you're basically 100% in the target date fund, right? And the way we do that is there's two models that are represented in this chart. One is you take 1.5 times your age, and you change that into a percent, and you put it in the target date fund. So if you're 20 years old, 1.5 times your age is 30. That would say 30% is in the target date fund and 70% is in the second fund. And that second fund could be large cap value. It could be small cap. It could be a blend of large and small cap value. It could be all small cap value. There's lots of ways you could do this. Or if you really want to be aggressive, you could go 100% in the target date fund at age 25. So you take 2.5 times your age minus 25, that goes in the target date fund. And using this formula, you ramp down to 0 in the small cap value by the time you get to age 40 or age 65, sorry. These actually get to target date fund 100% at age 66 plus a bit. So they're not quite the same, but it kept the math simple with a 1.5 times multiplier. So if you do that, we'll go to the bottom first. Does it ramp the risk down? Yes, it does. So you can see that now this is the target date fund on the far left. It ramps risk down as you approach retirement, and every one of these other strategies is ramping risk down as you approach retirement. So thumbs up, that's good. Does it still increase the returns, the median returns? Yes, it does. So remember, the Vanguard like was about $8 million. So a large cap value allocation with the 1.5 multiplier goes to about 10. If you do small cap, it's 9.5. A blend of large and small value went to 10.6. Small cap value went to 11.5. And the very aggressive, start 100% small cap value went to 13.8. And again, in all cases, the worst case scenario still got better. So this looks like a promising and interesting approach, right? And we've had a lot of people look at this and say, yeah, that looks like a pretty good plan. And if you think about it in contrast to the ultimate buy and hold, now you've just got 2 funds that you're working with instead of working with 10. So it's way simpler, but you still have international diversification. You still have diversification across asset classes because you've got small, large, you've got value and growth. You have emerging markets are in there too. So it's very broadly diversified. The one thing in terms of diversification you may pick up on is that if you only use 2 funds, this tilts you more towards a U.S. orientation in the early years. And if you want to still maintain that U.S. international orientation, at least today, based on the funds I know, you'd probably have to use 3 funds. But you could do that. You could take the portion that's going into this second fund and you could put it in an international fund and a U.S. fund, and then you'd stay totally diversified in terms of geography as well as asset classes. So we think it's a really interesting strategy that maintains a lot of the benefits Paul talked about earlier, but simplifies it. So since it looks like free money, some of you are probably asking what's the catch, you should. If you didn't, you should, because there's nothing like free money. You have to earn it. And in this case, I'm going to step out of investing for a moment and go to a different bet that we make on a regular basis, or a different calculation we do, and see if it'll help us understand. So since I'm talking to the Silicon Valley AAII, some of you will probably know about the legendary Stan's Donut Shop down in Santa Clara. And it used to be tradition for me, I didn't work at Google, but it used to be tradition for me that we would serve donuts on Friday to our team. So let's say for a second you're at Stan's Donut Shop down in Santa Clara, and it's rush hour, pre-coronavirus days, so there's actually cars on the road, and you want to know the fastest way to get to your team in the Googleplex. Well, you pull up Google Maps, and it gives you 3 routes, and it tells you one route is 32 minutes, another route is 33 minutes, and another route is 34 minutes. Do you know which route is the fastest route? The answer is not really. You can get on that fastest route, and partway there can be an accident. There can be a problem, right? And basically what Google's doing with their maps is exactly the same thing we're doing with investing. They're looking at all of the historical data that they have, and based on that data, they're trying to say what's the most likely fastest route for you to get there. But these are really close to one another. So you could start down the 32-minute route, and partway there, something could happen, and you could have chosen poorly. You really don't know. There's a huge amount of uncertainty. One thing that is fairly certain, though, is if you start down the 32-minute route and an accident happens, Google will reroute you. It'll give you some new information, right? And if you continue following that information, it'll probably get you there around the time that it estimated for the first estimate. So now let's take a look at the graph on the right and say you have a team that likes week-old donuts, and they're up in Fairbanks, Alaska. So you just bought your donuts at Stan's Donut Shop and you do the Google route. It gives you 3 different routes. Well, now these routes are really long. Do you know which route is the fastest, right? There's one that's 55 hours, one that's 58, and one that's 60. You still don't absolutely know. The road could go out, right? But the likelihood of that 55-hour route being the right one is really, really good. The likelihood of the other ones winning, pretty small. And the really important thing is that once you start down that route, you have to stick to it. So if you drive 100 miles down the 55-hour route and then second guess and turn around and go back to go to one of the other routes, there's a good chance that you're going to get there much longer than the time that it estimated the first time. So the same thing applies to any investing strategy. You have to stay committed. You have to decide that you believe in it. You have to understand why you believe in it, and then you have to stick to it. The price we pay for making any of these tilted strategies work, any of these strategies that veer off of S&P 500, is that we have to stick to it. We can't commit portfolio suicide when things go bad. We can't sell when the market's low and then decide when to get back in. So the price we pay to get these returns is a willingness to be different and a willingness to stick to the plan once we commit to it. So it's not free. It requires some work. It requires discipline. Okay, so if you followed me so far, you got a pretty good idea of what this would do for a young investor. But what about somebody who doesn't want to retire at age 65? What about somebody who wants to retire early? That 1.5 times calculation for your age gets you into 100% target date fund at the age of 66. If you want to retire at age 50, how do you get there earlier? Well, it's pretty easy to use the same approach for somebody who wants to retire early. You just kind of turn the equation around. So instead of using your age, you use your years to retirement, and you multiply that times 1.5. So if you're 30 years old and you want to retire at age 50, you have 20 years left 1.5 times 20 gives you 30. Now you put that 30% into the second fund, and you put 70% into the target date fund. So pretty easy to apply the same principles to somebody who wants to retire early. The follow-up question, though, is, okay, what does it do to all the numbers in the tables? And that's tricky to answer. And the reason is I'd have to have a whole bunch of different tables, because there'd be a table for somebody who is 30 years old retiring at 50, 30 years retiring at 51. It would get to be too complicated. But the same principles that apply to make it work for somebody who's retiring at 65 would still apply. You're offsetting bonds by taking a higher risk in equities for a greater portion of the curve. And if the future looks anything like the past, it has a high probability of being a prudent investment choice for you. So that's how we would apply this for somebody who wants to retire early. What about somebody who is either already retired or just about to retire? And the answer to that question, like many questions in personal finance, is it depends. And I'm not going to use that as a cop-out to tell you no more. I will definitely try and provide some answers here, but it really does depend. And it depends primarily on whether you've undersaved or oversaved or have saved just the right amount to retire. And what do I mean by that? Well, there's been a lot of analysis done many, many times in the past to say that if you can retire and only draw 4% out of your retirement accounts to meet your expenses on an annual basis, that you'll probably make it, right? You'll do okay. Now that's based on a whole bunch of assumptions. It's based on the assumption that you are going to have a diversified portfolio that's invested in taking a little bit of risk, that you're going to have a traditional number of years in retirement. You're not going to be retired for 50 years or 100 years. You're going to be retired for a more reasonable number of years. But let's use that as a base metric, right? So if we use that 4% withdrawal rule, for you to figure out where you are, you would look at you'd really start at the right-hand side of this chart. You would start by saying, okay, what are the expenses that I need to meet? What's the lifestyle I want to maintain? And then where is that money going to come from? Do I have Social Security coming in? Do I have a pension coming in? So let's say, just for sake of argument, that you have $100,000 a year in expenses that you need to meet in retirement, and that you're getting $20,000 a year in your Social Security and pension. I'm just trying to keep the numbers simple. I realize these may be optimistic for some people, but that would say that you have to get $80,000 a year to meet the rest of your expenses. Well, if you have $2 million in your nest egg, $80,000 a year is 4%, and we would say that you have saved just enough. If you have more than $1 million or more than $2 million in your nest egg and you need $80,000 to come out, then we'd say you've saved more than enough. And if you have less, you've undersaved. Now, what if you run this and you find out that you've just undersaved by a little bit? Well, you can come back over here and you can change your expenses, right? So these things all interact. It's not like they're all cast in stone. You can modify your lifestyle. You might find out that you've oversaved and come back over here and say, well, I want to have a nicer lifestyle then. I'm going to take it back to where I have a 4% withdrawal rate. Whatever it is, whatever you decide your plan is, that withdrawal rate is what we're going to use to determine whether you've oversaved or undersaved. So if your withdrawal rate is greater than 4% per year, our recommendation is you go see a financial planner. And the reason is it's probably going to require some creativity. And it may depend on a variety of things, right? It might depend on whether you can lower your expenses, whether you can generate some added income, work a little bit longer. There's all kinds of different ways to solve that problem, but it's probably not going to, that solution is probably not going to be on a boilerplate slide from Paul and me. It's going to come from somewhere else. And the only thing I would add in presentation is don't despair, right? Just because you're on the verge of retirement and you don't fit the mold, don't despair. There'll be a path forward. I don't know what it is, but maintaining hope will help you see that path and help it go well. Now, if your withdrawal rate is right around 4% per year, sticking with a 100% target date fund allocation is likely fine. It's prudent, and this is a period of time where there's a lot of uncertainty. So sticking with the target date fund is probably fine. And then you could consider adding a second fund over time, and I'll show you why and how that might look. If you've saved so that you have oversaved and your withdrawal rate is less than 4% per year, you could spend more, or you can put the extra in a second equity fund for legacy or for charity, right? Because effectively you've got money that you're not going to need within your lifetime, and so you can take a little more risk with it. Now, if you've been watching, you've probably figured out that this strategy, this 2 fund for life strategy, sounds like it starts out with a high equity allocation, and then it ramps down to 0 right at retirement, and then it may ramp back up. Why would you do that? Well, I retired 2 years ago, actually going on 3 now, and it was a very nervous time because you've gone from getting a regular paycheck out of which you're paying a lot of your bills and saving a lot to no money coming in, right? I mean, that's the way it feels, right? You might still be getting dividends, but you're not used to paying the bills out of dividends, right? You might be able to sell some stock occasionally and still have that be a prudent decision, but you haven't been doing that. And I remember my wife coming to me and saying, this was about 6 months after we retired, how do we get paid? How do we meet our bills, right? It was a very, very nervous time. And if you stay 100% in a target date fund right around that period of time, it's probably going to reduce your volatility, be a little bit higher fixed income allocation, and just help you to deal with that uncertainty. Now, 3 years into retirement, we probably have too much confidence. Now we're feeling pretty comfortable. It all works. We've met expenses. So that's a time when a lot of people might be willing to take a little bit more risk and ramp that equity allocation back up. So before I show you the numbers, because like Paul, I like numbers. I like graphs. He likes charts or tables. I like graphs. He likes tables. But before I show you the numbers, I want to, again, take us out of the world of finance for a moment and think about what we're doing here, right? We're putting a plan in place that we're going to hopefully stick with for many, many years, hopefully decades. And it's a plan that we could on a daily basis change. The world makes it super easy for us to change our finances now. We know that that's not wise and prudent, but we could. So what's a way to protect us from doing that? Well, I'm going to go to this NASA phrase called test as you fly and fly as you test. NASA has a huge amount of risk associated with a lot of the things that they do. And this rover on the right, I think, represents a great example of that risk. It costs billions of dollars to put a rover on Mars. And then when you drive it, there's a delay of many, many minutes between sending instructions and having them acted upon. So if you tried driving it with the camera, it would be almost no better than driving blindfolded down the freeway, right? Because by the time you saw that there was a problem, you couldn't do anything about it. So what they have to do is they have to look at the surroundings around the rover at the end of a day, and then plan out its route for the next day and send those instructions up and have it drive itself with no intervention. If they send the wrong instructions and it drives into a ditch and it can't get out, that's the end of billions of dollars of investment. So what do they do to reduce the chance they're going to drive into a ditch? Well, they have a rover on Earth, and they go and they run those instructions on the rover on Earth before they send them to the rover on Mars, just to make sure that they're not going to do something stupid, right? And if we think about this from an analogy to our investing, have any of you ever been tempted to make an impulsive buy or sell? I know I have, right? Have you ever been tempted to change your plan just because you heard something on the news, right? It happens. So one thing that we can do to protect ourselves from that is we can simulate what we might expect our plan, our portfolio to do, and then when news or new information comes in, we can go back to our plan and say, that was within the range of things that I thought might happen. I don't need to change my plan. And if I do decide to change my plan, I'm going to go and I'm going to check it. I'm going to simulate it before I change it. It could be as simple as looking at Paul's tables and saying, I'm 50-50 and I think I can take a little bit less risk or more risk. Well, you go read down Paul's table. That's running a simulation effectively, and you look at the outcome, right? So I think this idea of test as you fly and fly as you test is really important. And there's a cool tool that we can use specifically for people using a target date fund entering retirement. And it's the Portfolio Visualizer. There's a website called Portfolio Visualizer. It's free, www.portfoliovisualizer.com. And they have this thing called financial goals down here. And using that tool, we can model the changing allocation right at retirement for a target date fund and various withdrawal strategies. So I'm going to use that tool to show you what might happen in this 2 fund for life approach. But if you want to do it yourself, the instructions are over here on the left, and there are some links in here that you can just copy the links as well out of my presentation. You can use those and it'll get you started. So what does it show us? Well, if we go there and we run a simulation, this one's based on it's actually based on a 3%, 4%, or 5% withdrawal rate with an initial investment of $1 million. And that fixed withdrawal rate is actually increasing every year by inflation. So it's that's traditionally called a fixed withdrawal rate. And what we see is that if you start with a 100% target date fund allocation, and I modeled something that's a lot like Vanguard, and you do a 3% withdrawal, which is very conservative, right? This is oversaved. It's a good news scenario. Almost every number, so this is your worst case 10th percentile, a bad case 25th percentile, your median 50th percentile, a good luck 75th percentile, and a very good luck 90th percentile. They all make it well past 35 years, which is comforting. And there's a great chance that you're actually growing your money throughout that experience, right? The median example is going up in time. And you look at the end balances and you end up at $0.8 million to $4.3 million. And that's just 100% target date fund, 3% withdrawal rate. If you look at the 4% withdrawal rate, you can see why this is used as a prudent withdrawal rate for somebody in retirement. Yes, there are some low chances down here that you run out of money by about 30 years. So the 10th percentile runs out at 30 years. I think there's even some that run out around 29. But let's be honest, for most of us, there's a much greater chance we'll run out of life before 30 years of retirement than that we will run out of money. This is the prudent middle case, right, is a 4% withdrawal rate. And then a 5% fixed withdrawal rate, and you saw this on Paul's charts earlier, is not prudent. And only 34% of the cases make it all the way to 35 years. So there's a very high likelihood you run out of money and that you're losing money all the way along the way with a 5% withdrawal rate and 100% target date fund allocation. So now let's look at what happens with variable withdrawals, just quickly, kind of echoing Paul's presentation earlier. With the variable rate withdrawals, of course, you can never run out of money because you're only taking out a percentage of what you have, and we modeled 3%, 4%, and 5%. What happens here, though, that's interesting is you can look at the inflation-corrected amounts that you're taking out. And with a 4% variable withdrawal rate, by the time you get to the end of 35 years, you're taking out in real dollars, inflation-adjusted dollars, about 27% less buying power. And with a 5% withdrawal rate, given the 100% target date fund allocation, you're taking out almost half the buying power. So you can still take the same dollars out, but they don't buy as much. So just kind of another way you can use this tool. Now let's look at the two fund for life approach applied in retirement, where we're going to augment the target date fund with something extra, right? So let's start over here on the left with somebody who has oversaved, so they only have a 3% withdrawal rate. This is our baseline. They leave it all in the target date fund, and they end up with $0.8 million to $4.3 million. If instead they said, you know what, there's 25% of my savings that's not really for me, it's for something longer term, I'm going to put that into large cap value. Now the worst case got better, and the best case got better, and the median and everything in between. So you go from 0.8 million to 4.3 million to 0.9 million to 8.4 million, which is almost a doubling on the high end. And if instead you invested in small cap value, you get even greater change. And again, the failure rate and the bottom worst cases don't get worse. So it looks like for somebody who's oversaved, this is a good thing. Now, for somebody who's saved just enough, I said after you've gotten used to retirement, maybe you'd want to consider the possibility of investing in a second fund. And the reason is target date funds by their nature do tend to be pretty conservative. There was a quote from Vanguard that I thought was really telling. They said, if maximizing the end customer return was the highest priority, a higher allocation to equity would make sense. And I took out of that they're worried more about people staying invested in bad times than they are about maximizing returns. And so you have to, as an investor, know yourself and know, could you handle a little bit more volatility? But if you can, if you're the kind of person who can stomach it, these simulations show that putting an additional 10% into small cap value would, again, increase your returns and not dramatically, not even slightly change your worst case scenario. And putting 20% would do even more. So with 20% in small cap value for somebody in retirement with the bulk of their investment in a target date fund, it roughly doubles where they end up on the high end, and it increases the median substantially. You know, you're going from over here about 0.8, about $800,000 to over here 1.6. So again, it about doubles. So I think the strategy is simple. It's something you can apply as you're building towards retirement. You can apply it in retirement, and hopefully it's something people find value in. Just before I leave these simulation slides, these links up here, if you copy and paste them, will bring up the middle simulation, I believe, on the chart, and you can play with the assumptions if you like. So just a few loose ends. So which specific second fund should I use? If you want a list of our best-in-class funds, our best-in-class ETFs, you can find those at Paul Merriman. Could I use just a few more funds to get more diversification? Sure. So if you've got an appetite for 2 funds, or 3 funds or 4 funds, you could add the international small cap value. Somebody mentioned the Avantis funds earlier. Those are really interesting for that. And you could even add an emerging market fund. Third, can I use Portfolio Visualizer to model target date funds in the contribution years? Unfortunately, not yet. I know Tuomo Lappinen, who runs Portfolio Visualizer, great guy, and he's doing wonderful work. And it's already great that he made it possible for us to use it on the verge of retirement. Maybe in time we'll be able to add it for during accrual, but right now we can't do that yet. What's the biggest risk with this strategy? The biggest risk by far is portfolio suicide, losing hope and selling when the market's down. And then what if I don't care about complexity and want the ultimate target date fund? Read the Merriman Aggressive Target Date Fund Glide Path and Calculator. We actually developed a 10-fund solution much like the Ultimate Buy and Hold. Let's see if I can get rid of this call. Much like the Ultimate Buy and Hold, but with a glide path, and that's available on the website. So call to action. Number 1, recognize the resilience of young portfolios. Number 2, consider 2 funds for life in your working years. Number 3, when you're approaching retirement, calculate your withdrawal rate and consider using 2 funds for life in those later years. And then finally, test. So test your plan, set your expectations, and then stick with it. So with that, I will ask Paul, do we have any questions?
We do have a few. I assume you can hear me.
I can.
Oh, good. Okay. Well, the first one is actually you've addressed it partially. What about the 4-fund combo with the target date fund? Are you considering doing some, along with Daryl, doing some research using that?
So I haven't considered that. It's an interesting question. The thing that makes the ultimate buy and hold portfolio deliver a better return per unit of risk is there's 2 principles underlying it, right? One is diversification and the other is a tilt towards small in value. So if you look at using a 4-fund combo as your second fund, kind of, you would expect a result that is between adding an S&P 500, which I think I included in my AAII article, and adding a small cap value, right? I mean, I don't think that if those are all U.S. funds, I don't think that using the 4 funds is going to buy you very much other than some personal comfort, maybe in the feeling that you've invested in more winners, right? So in a year when large cap value does really well, you don't feel like you're missing out, right? So I think the 4-fund combo has an advantage in that respect, and that it might bring you some comfort. But in terms of the long-term returns, I don't think it's actually going to change things that much.
And the obvious challenge for a lot of people is having access to small cap value or large cap value. You came from a large growth company. Did you have target date funds and all these other asset classes available?
We did, yeah. I worked at NVIDIA for a long time, and NVIDIA had small cap value as an asset class. They had target date funds. They also had the ability to manage your, I forget what the name of the approach is, but we could have basically had our 401k funds shifted over to Fidelity and used their full library of funds as well, right? So there were a lot of different ways to do it. I think if somebody's really constrained in their 401k, the best thing to do would be to invest an additional amount of money, even though it increases risk towards the end of retirement. I think putting an additional amount of money into small cap value at a brokerage on the side is kind of the best of both worlds, because now you're saving more money, which can never hurt, right? And you now have full access to whatever funds you want. The only downside there is you can't balance the portfolio back and forth between the 2 accounts. But I still think that's a pretty attractive way to go.
And you use the Vanguard as the benchmark target date fund. Have you looked at others? Does the difference in glide path make any difference to the formula?
It does, and I made a comment at the end of my AAII article this month that I think it's T. Rowe Price has added some much more aggressive glide path funds. So they've added funds that have 0 fixed income in the early years. And I think that's, if you can do that, that's great. But if you remember back to the amount of risk that you're able to achieve in those early years, with the regular contributions, it's still pretty small. And as far as I know, none of the funds do any kind of tilting towards small in value or other higher return asset classes in those early years. So even if you started with a very aggressive glide path like the T. Rowe Price one, you could probably still see some advantage in investing some of your money in something that had a higher expected long-term return.
Here's one from Malik. Rebalancing is difficult at any brokerage account like Vanguard. No automatic rebalancing is available. How do I deal with this issue if I invest in 10-fund portfolio recommended by Paul?
Well, Paul, do you want to answer that one?
Well, of course, this is the reason the 2 funds for life became a focus for us, is because there are a lot of complexities with using 10 funds. Now, the good news is you did the homework and developed the portfolio, but being able to deliver it through M1.
Right.
Can you talk a little bit about M1?
Yeah, I think if somebody really wants the 10-fund portfolio and they don't want the headaches of having to figure out how to rebalance on their own, using M1 Finance is a great solution, because with M1 Finance, you set up your portfolio allocation, and then as any new money comes in, whether it's from dividends or a contribution that you've made, they allocate it to the underrepresented part of your portfolio first. So you're constantly rebalancing with any new money that comes in. And if you ever find that that new contribution process hasn't done enough to rebalance it to where you want, you can go in and click a button and rebalance everything. So I think M1 Finance makes it just super simple. And yeah, they're a small company, they're a new company, but they're like any brokerage, the assets are held by a holding firm. So I think the risks are relatively low and the ease of use is really high. Yeah.
And from Mike, in any of these scenarios in retirement, are you withdrawing cash to cover 2 to 3 years of expenses, or simply withdrawing cash for current year living expenses?
They were modeled with an annual withdrawal. So that means at the beginning of year, you would have a year of expenses available to you. If you want to have a cash buffer that's bigger than that, you can click on those links and you can go in and just add a cash allocation to the portfolio. So you could go run that if you want. It wouldn't be that hard.
Ron says, I use the 10-fund portfolio. I set up a spreadsheet, and all I have to do is enter the current price and verify the share numbers, and the sheet recalculates where my balance should be in each fund. Of course, there aren't many places where we can buy and sell ETFs with partial shares. But certainly what Ron is doing is what a lot of people have to do. And it's more work than most people want to do. Any comment about it?
Well, I created a spreadsheet like that for my daughter because she had the same question, how do I do my rebalance? And she's clever. She's a PhD physics candidate. She'll be graduating this year. And so she could have done it all on her own, but I just thought I'd help her out. It is a little bit of work, and especially if your 10-fund solution is in multiple accounts, right? Because now you have to figure out, you may end up with, you could probably forget some of them, but you may end up with 10 buys and 10 sells, right?
Yeah. Michael, I wanted to know, should I move some of that over to a small cap value, or just start making all my new contributions into small cap value?
So it sounds like he's asking 2 different ways that you could start taking advantage of this information. One is you do an immediate rebalance, and the other is you start making new contributions into the different one. Well, the new contributions will be a slower way of doing it, and so you'll have less time for that to make a difference. Yeah, in the end, that's a personal choice, and it's a little bit of a market timing choice. I suspect, right? I mean, somebody might be thinking, do I want to buy a lot of small cap value now or later? But it may also just be a comfort choice, right? If somebody's trying to get comfortable with a new asset class, and the way they want to do that is by dipping their toe in the water and then slowly getting into the lake, nothing wrong with that, right? You can develop trust and familiarity with it piecemeal. That's good.
David has, it's a bit complex, but he says small caps versus large caps. I appreciate the historic evidence on the significance of small caps. Having said that comparing Vanguard large cap VOO versus small cap VBR over the last 10 years, VOO has grown 147% versus VBR of 69%. Do you want to make any comment on that? How you can have major differences in returns through a range of value, growth, size, et cetera?
Yeah. So I think, Paul, you've emphasized this many times in the past, so I'll take a cut at telling your story. These asset classes can underperform for long periods of time. You can find yourself waiting for a premium for a decade or more. And so you remember my little segue or side trip in the middle about the price we pay for these returns is staying committed. The reason I like investing a portion of my portfolio tilted towards small value is that it's a multi-factor fund in some ways, right? So you have a reason to believe you'll get a premium because there's a market risk. You have a reason to believe you'll get a premium because it's small. You have a reason to believe you'll get a premium because it's value. And in our selection of the funds that we choose, we also try to choose ones that favor quality. So you have a lot of factors working in your favor that academics have shown are going to deliver good returns. There's no guarantee you're going to get that return in 10 years, 15 years, even 20 years. You might not get it. So it's a calculated risk. These last 10 years have been great for large cap blend, large cap growth in the United States. It's been an amazing run. I would not bank on that being the best asset class for the next 10 years. In fact, any asset class that's had a great last 10 years will probably be the one that underperforms the next 5 to 10 years, right? So I like having a lot of those factors working for me at once. And I think over the long term, it'll benefit me. But it's something, if I didn't have that belief, that core belief, it would be bad for me to invest in it because I would bail at the wrong time.
There's a great story about Dr. Fama responding to a comment by somebody who was pinning Fama's ears back and challenging the fact that for 30 years, small cap blend had underperformed large cap blend. And his response was, "You're not very patient, are you?" So it does take an amazing amount of patience. But when you build a best-in-class portfolio, and one of those asset classes is going to be small value, and there's a style box at Morningstar, where in terms of size and value orientation are you wanting to be?
Well, I'd like to be in the Morningstar style box. The bottom left-hand corner would be the small third percentile, and it'd be the smallest third percentile and the most value third percentile. So I'd like it to be down there. But I also know that there's a price you pay for getting farther into the corner. Any of the factors that have a history of return come at a price. Momentum comes at a price of trading, right? You have to trade a lot to get momentum. So when I do my best-in-class selection, I'm looking for the best return per unit of value. And so I might not go for the fund that is the farthest in the corner because it may have a higher expense ratio, it may have higher trading costs, And I've written multiple articles. One of them was in the AAII magazine. Another one's on our website about the process I use for determining which ones we get. But the goal is to get us, as far into the factors that we know have a good return or a premium, but not to pay so much for them that we don't get it, right? So it's an optimization kind of question.
So David is, to continue his earlier question, he says, given that small caps may struggle for the foreseeable future due to the recent pandemic, should one focus more on large caps, or is this the time to rebalance more heavily towards small caps as it is selling at a larger discount? It seems like we have a potential market timer on our hands here.
Yeah, it is a market timing question, and market timing comes in two different flavors. So Paul talks about trend following in his portfolio as a form of mechanical market timing that's all done automatically in the background based on an algorithm. But the other kind of market timing is the kind this question's getting at, which is, either based on objective data like valuation or emotion. Should I be making my purchase and sell decisions? And in general, both Paul and I would recommend against that, because most of the academic material that we can read says nobody's very good at it, even people who get paid a lot of money for it. So I would hesitate to change my strategy based on that. The closest I might come is I might use the RAFI valuations or like the valuation you just chose as a tiebreaker. So if I was looking at my, I've got a small trade and I'm doing some rebalancing, and it can be either small cap value or large cap value. And right now, large cap value looks to be at a historically lower price than small cap value. As a tiebreaker, I might use that piece of information, but in general, I would recommend against it, because it's just too easy to think that you're doing something that's going to help you out that in the long run takes you off of your plan.
Dick has a question about the February 2020 AAII journal showing that most target date funds have a risk grade of D or F out to years 2040. Why is that? Now, I don't immediately know, but do you have an idea?
I haven't looked at that. I'd have to look into it. It's an interesting question. That one, I'd want to go look into it before I replied, but yeah, I'd have to look. It's an interesting observation.
I know recently there have been articles talking about mass liquidations of target date funds. And one of the reasons I believe that these fine-tuning tables are important for young people to see and old people to see is that it just amazes me how often people are surprised by the size of the losses that happen based on the amount of equity that are in the portfolio, because there is nothing new happening to these portfolios today that has not happened in the past. It's just that we've had 10 years of bull markets, and maybe there are some people who don't believe that bear markets are part of their future, but they need to be prepared, I think, for that, just as you want to be prepared for the great bull market when it comes. So that may be part of the problem. Certainly, I would give a lot of target date funds a D or an F for expenses. I'd give them a D or an F because they're actively managed instead of passively managed. I would give them a D or an F because they're all cap weighted. What else? What other reason might you give them a D or an F?
Because they have too many bonds in the early years. But all of yours are good, though. Those are good, too. Yeah.
Okay. Let's see if we've got, here's one from David about, and bear with me here. Oh. I think I may have caught up them. Oh, let's see. Which monthly issue of AAII is your articulate on best-in-class analysis?
It was around the time of the national show, so I think it was October.
Okay. Dick says, for small cap value, is it best to buy index or managed funds?
I would generally buy index funds, but you can kind of peek under the hood. Some funds, like if you go to Portfolio Visualizer, you can run a regression on them and see whether they're really very active or very passive. So, but in general, I would go with, I want a transparent fund. I want one, so it may have some mechanistic trading going on, but as long as that's transparent, as long as they're consistent and they're not trying to make a judgment call, then that's going to actually show up in my testing as being a predictable fund that gives you exposure to the small and the value factors. So, but yeah, in general, index.
And when people in 401k plans have a small cap value that is actively managed, and let's say has a 4 or 5 star rating from Morningstar, which we know is not as meaningful as we'd like it to be, but how much of an expense ratio would you allow and still accept an actively managed small cap value fund?
So yeah, if you go back and look at the article, what I do is I look at, essentially when we buy these funds, we're buying factor exposure. So I use the Portfolio Visualizer tools to figure out, well, how much exposure am I getting historically, and how consistent is it? And then once you subtract out effectively, the alpha, which is their trading costs and expenses and any benefits they're able to bring, you end up with an expected return based on what those factors are worth. And so I try to do this all as mechanically and objectively as possible. And what washes out when you do that is funds with high expense ratios usually don't earn it. They don't. So typically most of the active, and this, it jives with the academic literature that says that active managers can't pick stocks to beat the market. And so it kind of falls out in the wash in just the method I use. But I don't have a hard line that says, I wouldn't look at a fund that had 1% expense ratio. I probably wouldn't actually look at one that was 1%. I'd probably be below 1 and below. So maybe I do have a hard line, but the process I use really is aimed at figuring out, did they earn it? Did they give me enough advantage over what they charged me that it was worth the premium? Because some of our funds are more expensive than others. They're not always the cheapest fund, but the data says they're earning it. So it's worth it. It's good. Yeah.
And by the way, it is common for us to get a question about, why would you recommend a fund that has 30 basis point expense, referring to, let's say, a small cap value, when you can get a large cap blend for 0.03%? How much more return do you have to expect from a fund that has higher expenses to justify leaving the relative security of the large cap blend?
Well, you need at least the 30 basis points back, right? So you need that. Let me turn that around though, and use a different example you and I've talked about. There are free funds, right? You can get funds that have 0 expense ratio. Why wouldn't you just always buy the one that was free? And, especially up around the large cap blend area, you might find free funds. And I do analyze those. And the result is that when you take into account everything that the fund delivers, they're not delivering as good a return as funds that have a fee. Now, how can that be, right? How can it be that you have 2 funds, same asset class, one's free, one has a fee, and the one with the fee delivers a better return. Well, it turns out there's all kinds of ways that a fund can make money. One of those is securities lending on the back end. Now, whether the fund chooses to pass the money they make off lending those securities onto their investors or not doesn't impact the expense ratio, but it does impact the return. Mm-hmm. So, it's important to look at the whole picture, right? That's the key, and that's what we try to do when we look for our best-in-class funds.
That's great. By the way, your comments here remind me that people will sometimes say, I love your work. I think you guys are doing great work. And I'll ask them about their portfolio. And they have virtually nothing that we've recommended in their portfolio, but they love our work, which makes me smile. I love it. If in your 50s, you're in your 50s and you want to be more conservative with asset classes and still apply this model, could 10% small cap blend plus 10% mid cap blend be substituted for 20% small cap value with similar improvement and less risk?
So I haven't run those numbers, but you could at Portfolio Visualizer, you can choose those asset classes. I strongly suspect that the shifting away from value towards blend will lower the returns and probably not change the risk very much. So I would not expect it to be an improvement in returns per unit of risk, but you can go run those. The reason I gave you the links is that it's pretty easy to use the tool. Of course, that's from me, and I'm spending time in spreadsheets a lot of the day. So maybe it's not easy for everyone, but I think it's a pretty easy tool.
There may be somebody in this audience today that sits as a trustee in a 401k plan. And one of the things I see so often is a small cap fund available, US. Invariably, it's small cap blend, not small cap value. And you just said something a minute ago about the risk between small cap value and small cap blend. What would you say to those trustees if you had their ear for 3 minutes?
Well, first of all, I would empathize with the situation that they're in, because unlike a personal investor who can choose how long they're going to wait for the factors or the funds they invest in to perform, somebody who's running a fund, any fund, is accountable to people who are very impatient, right? So I think there are things we as personal investors can do that they can't, and that's important. But I think I might, if they hadn't already read it, I might point them at Larry Swedrow's Factor Investing book, because I think his book really is great at teaching you why it's advantageous to spread your investment, your portfolio across these factors, and that the factors matter more than the labels on the funds. And in that book, he points out that and you can see it in the DFA data as well, the bottom right-hand corner of that Morningstar style box, the small cap growth box, is very poor performing. It drags portfolios down. So as you shift away from small cap value towards small cap blend, you're picking up a drag from that small cap growth, which tends to be companies that are small, they're not very well known, and they're overhyped, right? And so they're not going to perform very well. At least that's what has been true historically. So I'd point them at Larry's book, and then I would, I'd probably continue commiserating with them a little bit, because it's a tough position to be in.
And by the way, I would point them to almost any Larry Swedrow book. I think he's amazing.
Yeah, he's great.
I think this might be the last question, and it's the most important question of the day. From Bilal: what advice would you give to a first-time investor in the current climate?
Celebrate. The market's on sale. I sent a note out to my kids a little while ago because they're all in their 20s. And I said, you hear all this doom and gloom in the news. the market is on sale. You can buy your future on the cheap, right? So be depressed if you look in your accounts and you see that you've lost some money or that the balance is down. Get excited that that next contribution you're going to make is going to buy you a boatload more than it would have 2 months ago, right? You're getting a deal. And if you stick to your guns and you stay invested and you keep contributing, this is going to be a great time for you. Yeah,
that's great. By the way, I might share a study we did looking at the market from 1929 to 1938. Buy and hold $100,000 in small cap value, you lose over half of your money. If you dollar cost averaged in over 10 years, you compounded your money at 9% a year. It was great for dollar cost averaging. It was not great for lump sum. So, and I see we have one just popped up until they cut us off. I'm going to take it here. How could you summarize which strategy to do? 2 funds, 4 fund combo, or buy and hold for young versus old?
I think I'd give the same answer for young and old. I'd say it depends on what you believe in, what you're willing to manage, how much complexity you're willing to manage, and what you'll stick with, right? So if you really don't want much complexity and you can believe in that and you can stick with it, then 2 funds. If you can handle a little more complexity and you believe in it and you can stick with it, 4 funds, and right on up to 10. Yeah, I don't know, Paul, would you have a different answer? That one?
No, I think it's what you'll stick with, what you can do.
Yeah.
And oftentimes we are giving advice to other people. And please, let's not forget that what's okay for us to do and comfortable to do, for those people will not be comfortable. And so for almost all the young people I talk with, I'm emphasizing 2 funds for life. That's it. And then don't listen to people. In fact, when you're 15 or 20 years into that process, you're going to have a ton of money. And there are people who will crawl across crushed glass to get to you when you have that kind of money that they could put to work more effectively than you certainly can. And that is the time at which they most decidedly have to stay the course, because they're coming at you. They're coming at you, and you gotta know how important staying the course is. And by the way, I see a lot of thank yous from you folks. We really appreciate it. Paul at paulmerriman.com when you want to reach me personally. And Chris, do you want to give your personal email address?
Yeah, sure. If you send a question to Paul, sometimes it'll come to me, but you can get me at Chris K. Pedersen at gmail.com. That's all one word. So it's CHRIS, middle initial K, and then P like Paul, E, D like David, ER, S like Sam, EN at gmail.com.